Hello and welcome to this Forex News preview video looking at the flash GDP growth data for the first quarter of 2019, which are expected for release this Friday, May the 10th at 8:30 GMT. So according to forecast, the UK economy is expected to have a great start this year, growing by 0.5% in the 3 months to March compared to the 0.1% in the last quarter of 2018, while year-on-year forecasts are also positive, predicting an almost 2-year high of 1.8% expansion versus 1.4% recorded previously. Running through the data provided so far this year, we can say that a higher growth is not unlikely, especially if we consider the strong pickup in core retail sales, the drop in the unemployment rate, and the elevated wage growth that remained at decade highs. In other words, consumption may have been a key growth driver during the first quarter. The business sector may have been helpful as well, but mainly because of the stockpiling effect rather than improving sentiment. It's worth noting at this point that the Brexit delay was decided in April, so by March, businesses were still quite worried that a no-deal Brexit could happen. Therefore, to avoid any supply disruptions, they have probably brought some purchases forward, adding to the GDP growth. Industrial production and trade data for the month of March could support this view if the numbers strengthen as forecast suggest on Friday. On the monetary front now, the Bank of England was also optimistic at its previous meeting that GDP growth could rise at a larger scale in the first months of the year, but was also aware that the timing of the UK withdrawal from the EU and the type of the exit agreement are important for a more lasting expansion, saying that its projections are relying on a soft Brexit scenario. But even if the Bank of England's Governor Mark Carney said that hikes in interest rates should be more frequent than markets expect, the unproductive Brexit talks between the UK Prime Minister and the leader of the rival Labour Party over the past 6 weeks suggest that we might not see any rate hike this year if negotiations fall apart. In market reaction now, this means a short-lived recovery in pound dollar, probably within the 1.31 and 1.32 area, in case GDP data come in better than expected, as only a Brexit solution could provide a more sustainable rally in the pound. Otherwise, if GDP numbers appear below expectations, then the pair may end up lower, somewhere between 1.30 and 1.2920. So that's all from me. Thank you for watching and have a great day.